Hello guys, I see the first people are entering the webinar room. Hi Sanju, can you hear me properly? I see we have Chris, Jeff, Sanju, Dave, Cassava, they all joined. Yeah, you can hear me? Chris says he can hear me. Sanju, you can't? Okay. Well, Jeff can also hear me. That's all good. It's always good to do a few of these checks because before you know it, I'm talking for half an hour and no one has heard a word I said. So where are you guys from? Like I already heard that Sonju is from India. Let's see. Dave says my browser does not support this. Strange. Chris from New York, Massachusetts. Got some Americans. That's always fun. I'm just waiting a few minutes for other people to join in. And then we get this show on the road. Don't hear any sound. What could that be? Can you maybe... Oh, of course, when I talk, then they won't hear me. Hi. Okay, so can you fix it? Okay, so I got some people without sound. That's a bit of a shame, of course, since that's sort of like the whole idea. Oops. Let's try to get this guy full screen. Yeah, guys, can you double check if your sound is muted? Do you have sound? Do you guys have sound? Well, we'll just have to start, I guess. I mean, there's not much I can do on my end, since some of you do hear me. So let's just kick off. I already asked you where you guys are from. So let me just tell you a little bit about where I'm from. My name is Nick Kraakman. I'm the founder of valuespreadsheet.com, and I'm very excited to be here today. So why are we here today? Well, I intend to show you how you can analyze stocks in a very fast way. And I'll even let you guys shout out some companies that I will then analyze for you on the spot. And at the end of this webinar, you will know exactly how to analyze stocks in a fast way and calculate their intrinsic value, which is a key pillar of the investment strategy I try to share with you guys. I am from Amsterdam personally, so from the Netherlands. It's a beautiful but rainy city. And no, I do not smoke a lot of weed, if in case you guys are wondering. It's mainly the tourist. Really, it is. And English is not my native language, so apologies in advance if I happen to ruin some grammar here and there. And I want to make this webinar interactive. You guys already found out about the chat functionality. This way I can tailor the content more to what you guys want to know specifically. Yeah, well, Chris, we're not there yet, but just shout it out when you have once we're at that part of the presentation, then I'll analyze it for you. So remind me once we're there. In the coming, let's say 45 to 60 minutes, I'll try to teach you as much as I possibly can. And after that, I'll show you how you can get more help if you wish. And there will be plenty of room for questions during and after the webinar. But for now, let's get started. So, as most of you know, this is Warren Buffett, still the world's greatest investor of all time and the third richest man in the world, the last time I checked. And he said, whether we are talking about socks or stocks, I like buying quality merchandise when it's marked down. Of course, he said a lot of things, but this particular quote, I think, really captures his strategy in a nutshell, which is buying quality companies for a cheap price. So I have been studying the strategies of Warren Buffett, but also his teacher Benjamin Graham, but also Monish Pabrai, Philip Fisher, John Templeton, and many other legendary investors for a few years now. And even though the details of their strategies differ, they all base their decisions on the following two key questions. The first one is, how well is the business performing? And two, how much is the business worth? So this is their strategy is mainly referred to as value investing, and this value investing strategy is based on these two key questions, and all the investment grades I just mentioned employ this strategy. So how can you tell how well a business is performing, which is the first question. So how do you determine how well a business is performing? Well, that is done by looking at the financial statements. In the financial statements, the company shares how well they have been performing, how much revenue they generated, how much money came in, what their debt levels are, those kind of things. Very crucial figures to know when you try to determine how well a business is performing. So I just want to quickly show you some good resources for you to figure out this information. So yeah, again, sorry guys, I see some of you guys still have some issues with the webinar. The thing is, this is I'm using Webinar Jam as for my webinar software, and they just switched from using Google Hangouts to this, which is their own little player, and apparently it's not working super well. So I'll be talking to them about that. But for now, there's not much I can do, unfortunately. So I'm just going to show you guys some interesting websites to look at to figure out how well the business is performing. So let me just exit or minimize this guy over here. And so the first one I want to show you is Guru Focus. I'll also share the links in the chat so you guys can actually find it easy. So this is where we are now, gurufocus.com. You'll always be greeted with a lot of pop-ups, which is not too great, but other than that, it's a really cool website. For example, if we look for Apple, press enter, you get a whole lot of metrics and another pop-up. Let's click that away. So you see they have the PE ratio. They have a lot of ratios. They compare it versus the industry. Very useful. And they say 30 years worth of financial statements. This is what we're looking for. We were looking for the financial statements. Go away. So as you can see, they blocked out the first several years just because they want you to pay for it. But you see that they still have like 4 or 5 years worth of financial statement data. So let's see, this per share. What we have here is the income statement, which shows the revenue, the gross profit, net income, and earnings per share, all very important metrics, the balance sheet, and of course the cash flow statement. So those are the three financial statements we're looking for. And as you can see, this website has a lot of valuable ratios and financial information available for free. So definitely check it out. One more thing that's interesting here is if you click the DCF tab, the discounted cash flow tab, they have a little, another pop-up. As you can see, they have a little intrinsic value calculator, which is also very useful. So let's just hop over to the next one, finance.google.com. So what you have here is another financial website, a lot of news you can find. If we again go to Apple, just to make it easy, you see again they have some information, financial information over here. They compare it to some competitors. But if you click financials on the left-hand side, you see you can get either quarterly or annual data for the income statement, the balance sheet, and the cash flow statement. So again, all this information, all this data available for free. You really can figure out by diving into these numbers how well a company is performing. So new, the webinar started. Okay, so then we go to another. Oh, did I share the link yet? No, I didn't. Okay, let me just quickly share the link. And then we go to the next one. Another one you probably or may have heard of is finance.yahoo.com. So let's see, quote, Apple. And a lot of information. They have the financial data over here. But the most important thing I go to, the most important reason for me to go to finance.yahoo is because they have this section, analysts. They they ask a lot of analysts, financial analysts, like, what is your expectation for this company? Like, how do you think revenue will grow, etc. And it's all available here. So this is earnings. Let's see, earnings per share trend, estimates. That's all we need. So they estimate that Apple the next quarter will grow 38%, which is a lot. Of course, they're financial analysts. They're not fortune tellers, so their track record is not always too great. So you should always take these estimates with a bit of a grain of salt. But it's a very useful. This data is not available on many websites, so that's what makes this one unique. Then let me just show you one more that I find very interesting. Oh, let me share the link again, and then I'll show you one more that's very interesting. There we go. And then I'll go to the next. It's called jitta.com. It's a bit less known, but that doesn't make it less good, because it's actually a website fully focused on value investing. So let's see, you have a lot of stock exchanges to look a lot. It's Asian company, so they have a focus on Asian markets as well, which is very interesting if you're into that. But we click the United States, and we see a list of a lot of companies with some nice graphs. So let's see if I can search here. Yeah, search. We'll do again, Apple. So the cool thing they do here is that you see this Jitta score at the top. So it's a score based on how well the company is performing. So you can see here it scores a 7.7 out of 10. So it's pretty good. Of course, you can dive into the details of that down here, but the most important thing to know is that they have this JITA score at the top, which shows you a grade for how well the business is performing. And then they have a price, which is a price versus the JITA line. The JITA line is the black line, the black dashed line, and it shows you their calculated intrinsic value for this company, in this case Apple. So if the price, the blue line, is far below the black line, that could be a good place to buy. And the other way around, yeah, it's overvalued. So it's really a cool website. It's free. Chris says, do you ever use Morningstar? I do, actually. So let me just show you that one as well. Because that is indeed a very good website, which also has some very interesting metrics on there that you don't really find anywhere else for free. About this ad, I don't want an ad. So there we go. So we're looking at Apple again here. The thing I find most interesting on Morningstar is the key ratios, because as you can see, they calculate all these very interesting financial ratios, and they show it for 10 years, and it's free. It's public. You don't have to pay for it. So very, very interesting indeed, this website. Let me just share it with you as well. Oh, I already did. I already shared it. Okay, so those are a couple websites that give you all the data you need to determine whether a company is performing well or not. But as you can see, it's quite a bit of data to sift through. And so when I first learned about value investing a couple years ago, I understood that this approach of rummaging through this data is a very time-consuming task, and that it could be made easier by using Excel spreadsheets. And at one point, I was using about 9 different spreadsheets to analyze my stocks. And it took me several hours to retrieve and fill in all the financial data needed to analyze a single stock. And this was not only boring and time-consuming, but I was also making mistakes when entering the data. You know, it's very easy to type an extra 0 here and there, which of course throws off your entire analysis. So that's why I started to look for ways to solve these issues. First, I merged all my spreadsheets that I had together, and then I realized how amazing it would be if I could draw in all the required financial statement data into the spreadsheet automatically. And after several sleepless nights of programming, I finally succeeded, and the result was the very first version of Value Spreadsheet, a tool which allowed me to analyze stocks in seconds instead of hours, thanks to automatic data retrieval and smart calculations. And I successfully used this spreadsheet for several years for my own investments. And then I decided, actually based on the recommendation of a friend, that other people might be interested in this tool as well. So we are now several versions later, and Value Spreadsheet has evolved into a powerful investing tool that anyone can use on any device with an internet connection, because it is powered by Google Documents instead of Excel, which requires you to, like Excel requires you to install all these extra plugins, and that's not necessary here. And so I would now like to show you how the Premium Value Spreadsheet helps me to analyze stocks in seconds. And I will first run you through the most important features, and then you guys can shout out some stock tickers, and I'll quickly analyze them for you on the spot. So let's just open up the, let's see, did I just click it? Oh no, it's over here. So this is the Premium Value Spreadsheet. This is the dashboard of it. So what do we see here? We see a ticker symbol. This is the only symbol you'll have to fill in. That's all it needs. And this I can show you by filling in Apple here. And you'll see that all the numbers will start say loading. Takes a few seconds to retrieve all the data. And there we go. It has retrieved all the data, has performed all the calculations. Oh, it says I first have to log in, and Apple is the D. Okay, so now I'm logged in. So as you can see, it has retrieved all the information for Apple, and it has also calculated the score. Because remember, there were the two big questions: how well is the business performing? And the second question, how much is the business worth? So the score, just like the JITA score, shows you based on all these things that we check, all these factors, we calculate this score, which tells you in one number how well is the business performing. And then on the right, you see three different valuation methods to calculate the intrinsic value of this company. And that gives you the answer to the second question: how much is the business worth? So we have here, how well is the business performing, and how much is the business worth? Well, of course, this is a simple overview, but there's, of course, a lot more going on behind the scenes. So let's just show you how what that looks like. So we have the financial statements, 4 years of financial statement data, cash flow statement, balance sheet, and income statement. Which is then processed, all this data is processed to come up with all those numbers. There is one more tab called inputs, which draws in even more data, like the price, the earnings per share. This is, for example, the analyst estimate from Yahoo Finance that I showed you. And down here we have some key ratios, 10 years worth of key ratios coming from Morningstar. So there's a lot of data that we're working with, as you can see: return on equity, which is very important metric, book value per share. And these key ratios are actually nicely visualized on the graphs tab, as you can see here. So we have earnings per share, return on equity. It's all visualized nicely in these graphs. See that debt to equity for Apple has been flat, and then it's gone up in a straight line. Current ratio, all very useful and important metrics. So that shows you this part of the spreadsheet. But of course, I know that when I started, it was pretty. Let's see. It was pretty tricky for me to figure out what all these things meant, like what is a current ratio and what does it mean? So I added a tab to the spreadsheet that is actually shows you the analysis of all these numbers. So you have not just, okay, return on equity is this. No, it also analyzes this number and gives you a judgment based on it. So the judgment in this case is good. And then the comment is return on equity is consistently high, company capital is invested profitably. So in this case, where all those other websites just give you a mountain of data and just let you figure it out for yourself, here we actually process this data and pass a judgment based on it. So it really helps you out, especially if you are just starting out, Then let me just go to the dashboard. Like you can see, there are 3 valuation models: one based on price earnings, a discounted cash flow, and one based on return on equity. So I can show you them here. We have one based on price earnings. You see all the inputs that we use for the calculation, and then this is the final value that comes out of it. These orange fields, you'll see them on several pages in the spreadsheet, and what they are override fields. So this is the data we draw in from our data sources. It says it's has an Apple had an earnings per share of $9.19. If you think that's incorrect, you might just say it's 8. Then you see the value changes. So it's an override field to give it more, give you more flexibility to adjust the automatic data retrieval. Then there's the discounted cash flow tab. Similar story, all the input values, output value, and we also added a reverse discounted cash flow model to it. We also have a less well-known valuation method based on return on equity. The reason, by the way, that we have 3 valuation models instead of just one is because there's no one way that will give you the exact value of a company. I always tend to say that valuing a company is more art than science. So in this case, we just use 3 imperfect methods to come up with a rough ballpark figure. And that's as close as you will get to a proper value of a company. So this is the return on equity valuation model. These 3 valuation models are explained in detail in my How to Value Stocks ebook, which you can find for free on the website. So then the final tab, it's called Financial Health, and it's inspired by a book, which I have a link. I wrote a little blog post about it, which is linked down here. So I'll share the link with you guys. There we go. This is a book called It's Earnings That Count, and it's written by a certified financial analyst called Hewitt Heiserman. And he came up with a way to figure out whether a company would get into financial trouble anytime soon. And he did that in several ways. So for example, like these are the terms he used: accrual profit and defensive profit. But in fact, accrual profit is nothing, it's just a fancy word for earnings per share. And this is a fancy word for free cash flow. And so what he did is he compared if earnings were consistently higher than free cash flow, that meant that they might be cooking the books, as they call it. So they might be, fiddling with the numbers, because it is not possible in the long run to have high earnings but low free cash flow. Like, it can happen for a few years, but in the end, you need the cash to actually make a profit. So if those diverge from each other too much, it will be a warning signal, and financial health of the company might be in jeopardy. So that's just one of the metrics he used. We also have more traditional metrics like the Altman Z score that some people still like to use, which also gives you how high the risk is of bankruptcy within the next few years. So it really helps you to avoid making a bad decision. So yeah, that's all the functionality that's inside the spreadsheet, which is summarized on this page, the dashboard. As you can see, we also have a lot of orange fields here, and as you saw before, those are fields that you can customize. Because you might remember me saying in the beginning that all these big investors, they tend to use a similar strategy, but not an identical strategy. So while they both look at, okay, how well is the business performing and how much is the business worth, they do have their nuances, So for example, for Warren Buffett, return on equity is a very important metric. But if it's not important to you at all, you might give it less weight in the calculation. So in this case, I gave it a weight of 6. But if I would give it a weight of 0, it would be completely removed from the calculation of the score. And so if I remove it, you see that the score changes. And so this way, you have full control over which metric you want to take into account when in the calculation of the score. And so you can tweak it to your own personal investment strategy. So now that I explained to you how the whole spreadsheet works, are there any ticker symbols that you guys want me to analyze? I think, Chris, I heard you, I saw you mention one before. Let me just see if I can scroll back and find it. He said, Galif. Let me just fill that one in, see what happens. Yeah, that's what I thought. Let me just see, because they can't retrieve all the data. So there could be several reasons. And the main reason I can imagine is that it just doesn't, it's either not a very big company or it's not, yeah, it's not even, it's it's on the OTC market, it's on the over-the-counter market. So there's not enough data available for it to be calculated automatically. We like the spreadsheet supports stocks that are listed on the US stock exchange, on the Nasdaq, the Dow Jones, S&P 500, those kind of stocks. But as you can see, when I fill in this, if I fill in this ticker symbol on Google Finance, which is one of our data sources, you see that in the left-hand side, there's not even a financials tab. That's because there's just no data available for it. So that's why we can't run the calculations on it. Let's see, John Deere. It's on the New York Stock Exchange. DE is the ticker symbol. Okay, let's see what happens. Deere and Company. There we go. So it doesn't look too pretty. It did retrieve all the data, but you see it scores a 4 out of 40 out of 100. So then we can look like, why is that the case? So for example, it says the debt to equity is pretty bad. So let's see what's going on. We go to the graphs. This is usually the way I like to look at it, by just looking at the graphs. So debt to equity, as you can see, it's been high and creeping up. So at the moment, the debt to equity ratio is at like 3.6. Which is a lot, you know. It's a lot of debt compared to the equity that they own. So that's a bad sign. There's also things like net margin. It says it's bad. So let's see again at the graph, like what is so bad about it. We see that it's not super high. It's at like 6%. And it has been decreasing for 2 years straight. That's, of course, not what you want to see in a stock. You would like to see that a company is able to maintain or increase its profit margins. So that's the reason why John Deere in this case isn't. Yeah, Chris. Chris says go to Morningstar to find the data, but we use, as you see, the financial statement data here. This comes from Google Finance. So if Google Finance doesn't have the data for it, it won't be able to run automatically through this value spreadsheet, unfortunately. So let me just try some other ones. For example, Microsoft. Also not too great, as you can see. But you see how quick it goes, right? You fill in the ticker symbol, and within a few seconds, you have a initial analysis. And that's what I have to stress. It's an initial analysis. You shouldn't just blindly buy it after this spreadsheet says that it's a good stock, because you still have to do some due diligence, because some metrics that are important cannot be quantified. For example, if a management is shareholder friendly, that is really something that is very hard to put into numbers, but it is important when you analyze a stock. So let's try one more. Intel Corporation. As you can see, it has the valuation models, they differ from each other, and that results in an average estimate based on these numbers. If you think you don't agree with the average, which is sort of like the ballpark figure we're aiming for here, there is a override field here as well. You can, for example, say, okay, well, I trust that the price earnings valuation model is correct, so I fill in 36. See the numbers change. And what it says here is that based on a intrinsic value of $36, and a current share price of $43, it's currently 16% overvalued. And if you would purchase it today, taking into account the future growth, you would be looking at a 5% expected rate of return, which is not too great. So let's keep looking. I see that Third has set analyze fee as T. Let's see what happens here. I think. Let's see if it is able to get in all the data. Seems like it has. Yeah, there's a diff divided by 0 here. So for the accrual profit, which is happening here, you can see there's no data for 2013 for this particular metric, and so it doesn't have enough data to calculate it. There's just not enough data available, not enough years of data. We need at least 4 years of data for the analysis to work, because what else is a historical analysis is not worth much if you if you don't have a lot of data available, of course. Just look at Bed Bath & Beyond. It's always a decent one. So you see that this has a lot of good things going for himself. For example, the return on equity says it's good. Book value per share has gone up nicely over the last few years. Profit margin's going down though, so that's scary. Debt to equity is going up. That's not too great, but at least the earnings per share have been reasonably good, and the return on equity is consistently high, which is also very important. So now you've seen how the spreadsheet works. Let me just quickly go back to this little presentation we have going here. So what you've seen is the premium value spreadsheet. You saw it has 3 intrinsic valuation models in it. It's 100% unlocked, meaning that you can access all the formulas that are being used, and so you can tweak it to your own liking. There's a built-in fundamental analysis to help you guys who are just starting out. There are financial graphs that visualize the way the company is performing. Yeah, there's always free updates. Like, I never charge anyone for an update. So that's all included. And yeah, I reply usually within a few hours if you send me an email. So the regular price for this tool is $297. It is important to tell you that this is a one-off payment. It's not a monthly payment, as you will see that a lot of competing products they will charge you a monthly fee. That's not the case. This is a one-time payment for lifetime access. So right now, because I want to thank you guys for being part of this webinar, I want to offer you a special price, $100 off. This offer is valid if you decide within the next 72 hours to purchase the spreadsheet, and yeah, so don't miss this opportunity. As I said, it gives you lifetime access. Never have to pay any extra fees. This is it. You'll have access to the spreadsheet and all future updates. You can go to valuespreadsheet.com/big-deal. That will give you bring you to the page. Let me just share it with you in the valuespreadsheet.com/big-deal. So I shared it with you guys in the chat. And I can also show it to you in 1 sec. So yeah, like I said, it's available for 72 hours. Like I told you, I created this spreadsheet not as a product initially. I created this spreadsheet for my own use. I used it for several years before I even thought about giving this product also to other people. I always use it before I buy any stocks, and it really helps to save me a lot of time. Like I said, it usually took me hours to analyze a single stock, to go through all these fundamental analyses, go through the financial statements, and made errors with filling in data. And as you just saw, it's super easy now. You just fill in a ticker symbol, and that's literally all you have to do. And within a few seconds, you have a complete detailed analysis. You have financial graphs. You have everything at the tip of your fingers, which will, at the very least, allow you to sift through many more stocks before you make a decision. Because of course, if you spend 3 hours per stock to analyze, you will not be able to analyze many stocks in one day. Using this spreadsheet, you can analyze dozens of stocks per day. So let me just, so you can go to valuespreadsheet.com/bigdeal to make use of this offer. Let me just show you where you'll end up then. So you'll just end up on this page. You see at the top, the offer expires in 3 days. There's some more introduction. There's also some reviews from people who've been using the spreadsheet for a while. Some frequently asked questions. And then you see that you just have to fill in your name here and the email address you use. Make sure it's one of a Google account because, like I said, the spreadsheet is powered by Google Documents. And you see the original price was about $300, and now you can get it for $197 with the discount applied. And then all you do is check out with PayPal or with your credit card, and that's it. And then you're the proud owner of the Premium Value spreadsheet. And there is a money-back guarantee. If you decide within 7 days it's not for you, and that's all fine. Then sorry, someone just looked through the door. I was a bit distracted there. But yeah, within 7 days you can get your money back without questions asked. So no risk on that end. So just give it a try. Tell me what you think, and yeah, so go to valuespreadsheet.com/bigdeal to make use of this this offer. And if there are any questions, you guys can always email me. Let me just share my email address with you as well, nick@valuespreadsheet.com. There we go. So if there are any questions you have now, please ask them so I can answer them for you right now. And otherwise, I want to thank you guys for your time and wish you a great rest of the day. Okay, guys, I don't think we have... Oh, okay. Look, there's more questions. I almost ended the event. Any suggestions for screening, for stock screening? Jeff, the stock screeners I like to use are jetta.com that I just showed you, because you can also filter there on... so let me just go to that website for now so I can show you. So first of all, I always use Google Finance. We're already here, so let me just show you the stock screener of Google Finance. I love this one. It's very simple. It's very clear. You can add all these ratios you want to filter on. But recently I found that it's not always working properly. So let's see if it works now. Like, I think they had some bugs in their software. Let's see what happens if I... Does it do anything? I don't think it does. Like, usually it would start filtering as soon as you move these sliders, but it doesn't seem to do anything at the moment. So that's a shame. That was one I used to always use. There's also jetta.com, like I said, where you can simply filter on, there's here filter options. You can say which country, you can say the Jetta score. So for example, you only want companies that score 7 out of 10 or higher. And then you can sort them. So that's an easy way to find out which companies are potentially interesting. For example, this one is like here we see one 8.8. Click on it. So that's this is one way to do it. Yeah, like I said, I used to prefer the Google Finance one, but it seems to not be working very well. So yeah, those are my suggestions. The three or most important fundamental ratios. Yes, sure. So for me, there are the three most important fundamental ratios are one, the return on equity. I want it to be about 15% or higher and consistently above that. So not just 15% now and then it was only 5% last year. No, it has to be in the last 4 or 5 years at least, it has to be above 15%. Then the next one is the debt to equity ratio. So ideally, I invest in companies that don't have a lot of debt because that adds all these extra risks and it puts an interest burden on them. So the debt to equity ratio should ideally be below 0.5. Then the final one that I find very important is the current ratio. A current ratio tells you how well a company is able to meet its short-term obligations. Ideally, you look for a current ratio of 2 or higher. In that case, you have a company that is easily able to pay its short-term obligations, and so it is less likely to get into financial difficulties in the short term. So return on equity, debt to equity, and current ratio are the three most important fundamental ratios for me. I hope that answers your question, Jeff. Are there any more questions? Okay, perfect, Jeff. Well, I'm glad I could help you out in that front with answering your questions. I want to thank everyone again for being here tonight. Again, go to valuespreadsheet.com/big deal to make use of this offer for the next 72 hours. And yeah, have a great rest of the day, guys. Bye bye.